Another key important part of budgeting is utilizing a cash variance statement. A variance means how, it comes from varied, how something is different. So the cash variance statement exists to highlight any difference or variance between budgeted and actual figures. So remember, budgeted are our estimates that we make at the start of the period, while actual is what actually happened. The report looks quite like the cash flow statement, but we've got some additional columns. So we've still got our cash flow from operating activities, our net cash from operations, cash from investing, net cash from investing, all the way down to bank balance at end. Our golden rule over here. Golden rules, I should say. Any cash outflow that increases is unfavourable. So if more money is going out, but an increase in outflow, we're unfavourable. If the outflow decreases, that's favourable, because less money is leaving the business. So any cash inflow that increases is favourable. That means more money, more cash is coming into the business. If the cash inflow decreases, that's unfavourable. That means we've stopped getting as much money coming in. So we'd complete with our example here. So we could have sales as the first one. And of course they'd be cash sales because we're dealing with cash flows here. We could have budgeted $900. Then our actual was $1,000. Our variance is simply the number, so it would be $100. The difference between 900 and 1,000 is 100. Sales is a cash inflow, and it's increased. Our rule says that an increase is favourable. And that makes sense, so we put an F in there. We thought we were only going to get $900 worth of sales, but we actually got 1,000. So we got more than we thought. More money coming in, that makes us happy. An example of an outflow could be payments to creditors. So how much money we're paying back to our creditors in the period. We could have, for example, said we were going to pay $500 back in our budget, when actually we paid $1,000 back. Our variance is simply the difference between the two numbers. So 1,000 take 500 is 500. We don't have to worry about any brackets on the variance figure because we know that the brackets here are outflows. The outflow has increased, so that's unfavourable. We've paid more money than we were expecting to. The only tricky part about this is, for example, if we were looking at our investing, so we're focusing on non-current assets. If we thought we were going to, so we're going to sell our old delivery vehicle. And we thought that we were going to get $500 for selling it as our scrap value. But what actually happened is we had to pay $100 for someone to pick it up and take it away, and we didn't get any money for it. This time, the variance won't simply be 400, it will be 600. Because we need to take into account that we're originally having $500 coming in. Not only are we not getting that $500 anymore, we're actually sending $100 out. So the difference is 600. We can think of this as negative 100 and 500. To come down from 500 to negative 100, we need 600. This, of course, would be unfavourable. We've had a decrease in an inflow. We thought we had $500 coming in. It's decreased all the way that it's become an outflow. So it's very, very unfavourable. Any item could appear in here as long as it has to do with a cash flow. Our variance column is simply the difference in number. This is our only tricky part here. And our golden rule states when things will be favourable or unfavourable.